Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly newsletter. Today's date is the 17th of February. Let's dive into the week's stock market news. Navigating uncertainty. European equities poised for continued growth after solid 2024. The year 2024 presented a complex investment environment marked by geopolitical instability, a hesitant recovery in China, and ongoing interest rate adjustments. Despite these headwinds, European equities delivered a second consecutive year of strong performance, prompting analysis into this resilience and the outlook for continued growth. This positive performance was underpinned by several key factors. Firstly, European equities entered 2024 with attractive valuations, creating fertile ground for appreciation as recession concerns eased. Secondly, corporate earnings demonstrated surprising resilience across sectors, with disappointments being isolated incidents. Thirdly, consistent and appealing dividend payouts, averaging 3.5% for MSCI Europe, provided stable investor returns. Looking to 2025, the economic outlook for Europe suggests continued modest growth. However, European corporations are increasingly positioned to capitalize on global growth opportunities beyond the continent. Current undemanding valuations present an intriguing scenario, with potential for significant upside should economic recovery accelerate. While political risks remain, they also bring potential opportunities. Earnings projections for 2025 indicate a return to growth, supported by a weaker euro boosting exports and international revenues. Sectorally, the dynamic between cyclical and defensive stocks will be crucial, with diversification remaining key to risk management. In 2024, MSCI Europe achieved an 8.6% net return, less than the US S&P 500's exceptional 25%, but still commendable given the challenges. Key trends emerged. Small caps continued to outperform large caps, and value stocks outpaced growth stocks, driven by financials and telecommunications strength alongside higher interest rates and tech underperformance. Country-specific factors were significant. French equities faced headwinds from political uncertainty and luxury sector pressures, while Spain and Italy benefited from banking sector recovery. Germany saw strong performance, notably driven by SAP, while Switzerland underperformed due to Nestle's struggles. Sector analysis reveals further details. The luxury sector, typically strong, faced headwinds from slowing Chinese sales, though a cycle bottom is anticipated. European banks thrived on high interest margins, lower loan losses, and consolidation. Insurance also performed well, benefiting from the evolving interest rate environment. Industrials navigated weak European and Chinese demand but capitalized on secular trends like electrification and digitalization. Chemicals saw earnings rebound from a weak 2023. European tech faced a downturn, particularly in semiconductors. Automotive was a clear negative outlier, with profit warnings amid the EV transition and increased Chinese competition. The broader 2025 economic forecast for Europe remains subdued, with projected Eurozone GDP growth around 1% and downside risks prevailing, as indicated by weak manufacturing PMIs in Germany and France. Potential tariffs present further risks, though ECB rate cuts might offer some support. The political landscape, both within Europe and globally, will heavily influence market outcomes. While US political discussions focus on tariffs, the broader impact includes potential benefits for European companies with US operations from tax cuts, and relative advantages if tariffs target China. However, the ultimate impact on inflation and the US fiscal deficit remains unclear, potentially tempering initial market enthusiasm. In conclusion, despite persistent uncertainties, the outlook for European equities in 2025 is positive. While risks are present, significant upside catalysts exist. Stronger Chinese stimulus, avoided broad US tariffs, and resolution in Ukraine could provide tailwinds. German election outcomes and potential fiscal stimulus could reignite growth. European equities offer diversification benefits compared to the US, and valuations remain attractive, with a widening discount, presenting compelling investment opportunities as strong European companies trade at significant discounts to US peers. European equity markets offer a well-diversified, attractively valued investment proposition with a favorable risk-reward balance for 2025. Now our insight into alternative markets, the allure of aggregation. Why investors are captivated by roll-up strategies. In the world of mergers and acquisitions, the roll-up strategy holds a particularly magnetic appeal for investors. It's a concept that promises to transform a collection of smaller, often fragmented businesses into a significantly larger and more valuable entity. But what exactly is it about roll-ups that makes investors so enthusiastic? The answer lies in the inherent value creation potential meticulously woven into the very fabric of this consolidation approach. The core attraction of a roll-up is its ability to unlock and amplify value in ways that are simply unattainable for individual, smaller companies. This value generation is achieved through a powerful combination of strategic advantages, each contributing to a more robust and profitable enterprise. One of the most compelling benefits is the realization of economies of scale. Imagine a scenario where numerous small businesses, each operating independently, are brought under a single umbrella. Suddenly, the newly formed, larger organization possesses a dramatically increased buying power. This translates directly into reduced procurement costs for supplies, materials, and services, benefits that far exceed what any of the constituent smaller entities could negotiate alone. Beyond simple cost reduction, a well-structured roll-up strategy unlocks a wealth of synergies that further enhance value. These synergies manifest across various operational areas. For instance, consolidating administrative functions, such as accounting, human resources, and legal, eliminates redundancies and streamlines operations, leading to significant cost savings. Similarly, merging marketing efforts can create a more impactful and cost-effective brand presence, avoiding duplicated spending and broadening market reach. These synergistic gains, often realized at the margins, collectively contribute to a more efficient and profitable bottom line. Furthermore, size matters in the business world, and roll-ups deliver precisely that: increased scale. The larger entity born from a roll-up strategy benefits from increased exposure. A bigger company commands greater attention. It gains access to a wider audience of potential customers, partners, and even acquisition targets. Increased scale also elevates media visibility. The consolidated entity becomes a more prominent player in its industry, attracting press coverage and industry recognition that smaller, individual businesses could only dream of. This enhanced profile not only boosts brand awareness but also solidifies market position. Crucially, larger companies, as a general rule, gain access to better opportunities, including capital. Financial markets often reward scale with a liquidity premium. This means larger, more liquid companies typically enjoy a lower cost of capital. They can access funding on more favorable terms, making future growth initiatives and strategic moves, like further acquisitions, more readily achievable and financially attractive. This virtuous cycle of growth and access to capital further solidifies the value proposition of a well-executed roll-up. However, it's vital to understand that the roll-up strategy is not a magic formula for instant wealth creation. The promise of value generation is contingent upon meticulous execution and a highly disciplined roll-up strategy. Simply acquiring a collection of smaller companies does not automatically guarantee success. The inherent complexity of acquisitions, even of smaller businesses, demands diligent project management at every stage. As experts in deal-making consistently emphasize, acquisitions, regardless of size, are intricate projects requiring rigorous planning, cultural and operational alignment, comprehensive due diligence, and a carefully considered deal structure for each and every acquisition. In a roll-up scenario, where multiple acquisitions are undertaken, this workload is amplified, not diminished. The temptation to cut corners when acquiring smaller companies must be resisted. In fact, careful attention to detail becomes even more critical. Neglecting thorough due diligence in even one acquisition within a roll-up can introduce unforeseen risks and derail the entire strategy. Failing to ensure cultural and operational fit can lead to integration challenges and the destruction of value rather than its creation. A poorly structured deal can saddle the newly formed entity with excessive debt or unfavorable terms. In conclusion, the allure of roll-ups for investors is deeply rooted in their potential to unlock significant value through economies of scale, synergies, increased exposure, and enhanced access to opportunities. However, this potential can only be realized through a disciplined and meticulously executed roll-up strategy. Investors who understand the inherent complexities and the critical need for a rigorous approach recognize that roll-ups, when done right, can indeed be a powerful engine for value creation, transforming a collection of smaller parts into a significantly more valuable whole.
Thank you for listening to this episode of Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T Hub Capital and our activities, visit our website, hubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T Hub Capital team.